Unfortunately.
So or they can both go up.
Yes, that's right, and that's the other option too, because what doesn't stay the same, although the tax rate has stayed the same for over 10 years, what hasn't stayed the same are expenses associated to the services that us as a city have to provide our citizens. There's inflation, things go up in price, so expenses get higher, but over the past 10 years, that tax rate has stayed the same. And the property value growth has not kept up with those increasing expenses. So now you have your tax rate here. It's not collecting enough to not only pay your debt obligations, but to just pay for annual expenses to service our citizens and provide them that service. So that was the city's first option. Option number one was to raise the property tax rate, start taking over that shortfall, and then just cover the debt until the 4A corporation got on its feet, the sales tax collection started coming in, and the growth started being experienced. And then after that, the city could have laid off a little bit, and then the 4A corporation could have started taking care of itself again as it originally intended to. And really, option two is probably option number three. Option two was to conduct the restructuring. There was not a willingness or wanting to increase the tax rate. It's been essentially the same for many years, and the city council said, well, this is the 4A corporation's project anyway. The plan was for them to pay it. We don't want to raise our tax rate. And so the second option, well, you have to conduct this restructuring of the 4A corporation, part of the debt issuance. Because the second option is obviously nothing that anybody would advise you, and that would be to default on the bonds. If you didn't want to raise your tax rate, if you don't want to go through a restructuring, what's the other option? Well, the other option is I don't pay my debt, I default, and that obviously isn't good for the city, because all of a sudden you get these bondholders coming in, suing you, and they'll force you to increase your debt service tax rate, whether you like it or not. There will be a judgment on you and force you to increase that tax rate. And of course, a default in bankruptcy never looks good on a city's resume, and will hurt your opportunity to go and finance things that you may need in the future. And so those were essentially, ladies and gentlemen, the three options presented in 2010. We could raise our tax rate, the city could, and we could make up the shortfall. We could restructure the 4A corporation's portion of the debt, or we could go into default. And of course, nobody's going to advise you to go into a default. And so the decision was made at the time to go ahead and let's conduct this restructuring. So we go now to the next page here, page 13. Now we're just looking at the 4A corporation's portion of the certificates of obligation since 2008 issuance. Here under column A there, this is what originally in 2008 when it was issued, as we talked about in the previous page, the 4A corporation, this is their responsibility of the $8.5 million issuance back then. It was going to be ranging from $375,000 per year for principal and interest payment all the way to $410,000 in that 20th year there. Again, in 2011, it was projected that our revenues from sales tax were only going to be $410,000. We had this $374,000 that we had to pay. We had the land, $85,000 we had to pay. Then we had the Bank of America loan that came unexpectedly, and now we had to pay that too. So the decision at the time was made to not increase taxes and obviously not going to default. Let's do a restructuring. And so we stripped out the 4A corporation's portion of the debt, and then now that's column B. That's the product of that 2010 restructuring and the stripping of that community center debt now is represented under column B. This is the way it was structured in 2010. And you're saying, well, why originally it was 20-year obligation. Why did you do a 10-year obligation and kind of a balloon payment in years 5 through 9 here? Well, when we did the restructuring in 2010, we had two options in how are we going to structure the debt. We could try to do what we did in 2008 and predict our sales tax and think, okay, I'm gonna set these payments for the next 20 years, and I'm thinking the sales tax are gonna, be this. We were still climbing back from the economic downfall in the nation. So the other option was to, okay, let's do a temporary restructuring essentially, and let's give the 4A corporation 5 years of debt repayment relief. And so that's why you see here the first 5 years was $100,000, because all we knew in 2010 was our projected sales tax would be $410,000, but our obligations were more than that. They were close to $560,000. So when you do a refinancing or a restructuring, unlike when we do a mortgage, we could essentially refinance at any time we want, so long as we're willing to take on those closing costs. And it doesn't matter if we reduce our interest rate, if we need to extend our debt, things like that. As a mortgage borrower, we could do that as many times as we want. Because tax-exempt bonds are highly regulated debt instruments, highly regulated by the Treasury Department and the IRS. There's very specific rules as to what you can use that money for. Again, it has to be for public purposes, like we talked about earlier. And then the IRS also has a rule that you can't go and refinance as many times as you want or restructure these bonds as many times as you want. You only get certain shots at it if you want to do a restructuring. So we knew that this is going to be our one, basically, out of 2 shots that we needed to do. So the other option, instead of scheduling now the next long-term payments and just doing one restructuring in 2010, not knowing what our sales tax were going to be because things are still not as in good grounds yet. What we wanted to avert, the risk of having to come back and do another restructuring, even though the IRS probably wouldn't let us do that restructuring. So you would pretty much be in a bind. If you were to do a long-term restructuring in 2010, you would have been stuck with that debt service payment that you agreed to with the investor over the next 15, 10 years, however you wanted to restructure back in 2010. The decision was made by the 4A and the city that can we buy some time and see, get the Bank of America loan off the books, because we knew that was just a temporary 5-year loan. Let's get that off the books. And then let's see, more importantly, where the sales tax collection was going to go and be that. So they said, can we buy some more time? And so we came up with this restructuring option here, where we said, okay, let's structure where there's minimal payments in the first 5 years. You'll have enough money to make your Bank of America loan, the land loan, and then enough to make this $100,000 payment here. But the intent wasn't to keep it like that. The intent was to see where the sales tax was going to be in the next 5 years. The intent was going to be to go in 2015, the Bank of America loan would have been off the books already, and we instructed them, don't do any of those loans again, because that limits our options. The intent was to have these minimal payments for the first 5 years, let the 4A corporation get back on its feet, get the Bank of America loan off the books, see where the sales tax collections were going to be in 2015. And so the plan here was to go to 2015. At that point, these bonds are callable at that point, meaning that the IRS will allow us to go ahead and conduct another refinancing at that point. And see where we're at in 2015, basically. Where have our sales tax collections been in the past 5 years? Where are we at now? Again, that Bank of America loan is going to be off the books and never to come back again by way of another loan. The land loan is still there. But the plan was to come back intentionally in 2015 and do one final restructuring. Because again, I just can't say this enough. The Bank of America loan was going to be off the books then. And at that point, it would have given us a better look as to where our sales tax collections as a 4A corporation was going to be at that time. So the plan was going to be to come back in 2015. At that time, pull the trigger one final time is what the most prudent thing would be to do. And then after that, see where our sales tax is, how much can we afford in principal and interest payments, and do one final restructuring and stretch out that debt to wherever it needed to be. So that we could afford our debt obligations just using the 4A corporation sales tax collections at the time. So this was intentional, ladies and gentlemen. This was intentional to give a reprieve for the 4A corporation for the next 5 years, come back again in 2015 and see where we're at. And then at that time, pull the trigger one final time on that community center financing, stretch out the debt, and the intent was never to keep it at that $1.3 million amount there for the next few years. The intent was to come back and do a final long-term restructuring of that debt and hopefully just keep it that way. At that time, the hope was the sales tax would be comfortable enough to now handle this newly revised or restructured debt payment that we do in 2015. So the intent again was not to keep it that way, the intent was to come back in 2015, see where we're at, and then do one final restructuring.
If that loan would not have been taken out, we would not be in this boat right now.
The 2008 loan? Yes, ma'am. No, that's exactly right.
That's the Bank of America loan.
Yeah, you could have managed it, because again, the shortfall on the previous page was $150,000 that was projected in 2011. Obviously that Bank of America loan, that's $100,000, it's just $50,000 and a whole restructuring wouldn't have been advised to be conducted for $50,000. Something else maybe you didn't have to raise your tax rate at the time, maybe you could have scrounged up other funds for that 1 year from other revenue sources that the city had or the collections and then just, fulfill that shortfall of $50,000 and that would have been my dream or ideal. Of course I get paid when I issue bonds, but, we're here to look out for the economy, make sure that you all do the best thing for the taxpayers and the ratepayers. And so, yes, ma'am, had that Bank of America loan not been there, you could have had something a little bit more to work with at the time. But the $150,000, again, was just not something that the city, by way of increasing its tax rate or finding other funds, was willing to fill that shortfall for the Ford Corporation. But you're right, if we not had that Bank of America loan on the books, it would not come to this.
How many years are we looking at when we do the final restructuring?
It's a determination that the 4A Corporation and the city will have to make in 2015. We're looking probably at spring 2015, and the city could go after this final restructuring. It's going to depend on two things. Where are our sales tax collections at the time, and where is the 4A Corporation comfortable in having its long-term debt payments? If you want smaller payments, just like a mortgage, you do a 30-year bond. We're not going to go 30 years here, but this is an example. If I want to get out of debt sooner, but my payments are going to be higher on an annual basis, I need more cash, so you're going to do the 15-year loan. So that determination is going to have to be made by the 4A Corporation and the city in spring 2015 when the restructuring has to take place, and see what annual payment are we comfortable with, and more importantly, what annual payment can we afford. And so you could do a 10-year if you want, you could do 15 or even 20 years. It's just going to depend on what you're comfortable with.
Victor, going back to page 10, a couple of questions on that. Is that piece for the city also, during some period of time in there, they started, instead of giving the money to the Chamber of Commerce on some of the hotel motel tax and different things like that, none of this is hotel motel tax, correct?
No, all of it's still.
Okay, and also on your shortfall that you're calculating, I don't know what the community center's loss is each year out there, 150, 200,000. So you're gonna have to subtract off of what they're collecting, $200,000 or some number for maintenance and everything that they have to have for operating. Is that correct? And you're aware of?
Oh, no, that's exactly right, yeah.
Okay.
We're trying to simplify here, so we're just looking at the debt, because that's what we're talking about. No, you're right, in spring 2015, when that restructuring has to start getting intense and planning and being conducted, we need to look at everything. We need to look at sales tax, we need to look at the land loan that we have out there, maybe can we refinance it, reduce that $85,000 payment, get a lower interest rate, maybe that'll help us. We're going to look at what kind of a payment we could afford on the new outstanding bond, but really the new structuring and the long-term restructuring that we have to conduct in spring 2015 is going to be dependent on, number one, the sales tax collection, number two, how much money do we need just to operate the facility, because, just like any other facility, the revenue is being generated internally for the use of that facility and events occurring. Typically, sometimes might cover maintenance and operations, sometimes might not. And so those are all those things have to be looked at.
Okay. Picking up on Mr. Eubank's question, why in calibrating our thoughts on the Civic Center have we never cranked in the availability of the hotel motel tax?
From my understanding, and I'm not a bond attorney, but the hotel motel tax has very specific uses. And probably a better question for the bond attorneys, but even when the issuance was first conducted, the plan and the intent was just for the 4A corporation, because that's their side and just their sales tax collection. The intent was to have them take care of all of this stuff. In regards to the hotel motel tax, I'm just knowing, I'm not a lawyer, I'm just knowing not to be dangerous, but it has very restricted.
I've
there's-
researched it, it's an eligible cost.
I'm not sure it could service the debt. Now, it could
I'm not sure it
probably-
can service the debt,
You
but it
could
can
probably
service.
service some of the expenses
Right,
for
and
operating.
therefore you
Operating.
restrict, you make
Right.
other funds available to service the debt.
Yeah,
But as it is, the expenses for the civic center are very high
they are.
in regards to the revenue. So even if you use some of the hotel motel tax, it will only be to cover the deficit that they have.
Mhm. Yeah.
Because as
That
it is
would
right
save
now,
us, that would save us from the general funds supporting the.
yes. it
Well,
will,
but
because
I-
right now we're supporting it.
But I think that there's already been money pulled out last year, even from the hotel motel tax, to offset some of the existing.
No,
No?
no,
Okay.
no.
We got $300,000 sitting in there.
Yeah.
How much?
300.
Well, I guess, one other thing, I guess, as this conversation takes place, is there's a lot of lessons learned in this room. Number one, just simply building it doesn't mean they'll come. And the other thing is that when we make projections, when you go back all the way, regardless what happened in 2008 in the market and so forth, you look at probably what the revenue was at that time, it was questionable. Actually, it was not questionable that the facility or the 4A could support that kind of debt. You look at, if in 2008 the revenue was $393,000, just simply a 10%
Increase
decrease
or decrease.
in the tax as a result of the economy would have thrown you in a tailspin anyway. And so I think that, I do projections in my business. I know, Victor, you've been doing it a long time, but sometimes, we have also outside pressures. We gotta get this done. And, I think there's a lot of things that came together here that probably shouldn't have ever come together. And now we're having to look at this and figure out, well, how does it get fixed and make the best of it? The one thing, though, that you did say, that I think, and I hope everybody in the room heard, that your property tax values are not increasing enough to sustain city growth. You have to increase some tax revenue to sustain services in this community. There's no way around it. I've been totally baffled why the city chooses not to increase the tax rate. Y'all get paid how much a meeting? It's not like it's a $100,000 career, okay? I don't know why it doesn't happen. It has to happen. Towns like New Braunfels, San Marcos, those are huge cities, I know that. And they're growing because they're on the interstate. But they increase their taxes too.
We went to the rollback last year, which was, yeah.
It's gonna have to happen. We can't keep operating in deficits
But that was the max that we could do without having
to
to.
get the services we need. Y'all been talking about a sewer plant for a long time. And the only way you're gonna get a sewer plant is start looking at revenues to have available for that.
The only way that the city can raise property tax is to go into an election. Because for the last 10
Right.
years, they've been choosing to pick the rollback. And that's your cap for a year. So if you're already doing the cap, and then you cannot go any farther up unless you put it on the ballot. And that will be the only way.
Right. Well, I know that, but
And
it's
To
gonna
raise
have to
property
happen.
taxes.
I pay city taxes. I don't want my taxes to go up, but if I see something for the taxes, then I'm okay with it.
And, I kind of see it as, there's no way that the property taxes are gonna stay the same. Even if we raise the rate, the citizens are still gonna get hit twice. You're gonna get hit twice, Andy's gonna get hit twice, because the rates are still
Well, we
gonna
get
go
hit
up.
20%,
But you know what?
28% on some items in the grocery
Nobody
store. I
complains
mean,
when
it
the
just
gas
is a
goes
fact of
up,
life,
Your groceries go up, your medications go up. That gas has been going up left and right. Nobody complains about that. Those things are not helping the city grow. We have no infrastructure. We're so behind in that. We have got to stop looking at that and go forward. And nobody likes to think that their taxes are gonna be raised, you know, but
And then the
And
other,
I agree, Mayor, on your opinion, but gas prices, they go up, and whether the city complains or, you know, there's nothing we can do about it.
no.
Just like the groceries.
Right, just like the groceries and everything else that is going up. Now, when it comes to the sales tax, there is something that we can do about it. And I'm not saying about going to Springs and going and pick it up, you know, very high, because you also have a guideline on how much you can go
Right.
up.
and
But-
we understand that, but HEB, when they grow, they add more employees, they add more stuff, and guess what? Their prices have to go up, and every one of those companies that they're buying from has to do the same thing. The city's no different. Our box of revenue is too small in the city, because we've never had the expansion of those lines in terms of city boundaries. And we're having to live in this little box that we can't grow anymore, and we're very, very limited.
It can get posted on, you know, on a regular election, correct?
What's that?
On a,
To increase the rate? Yeah.
Anyway, that was, sorry, I got everybody sidetracked, but that's just kind of an opinion.
No, I mean, I agree with that. I mean, did the 4A probably overextend itself initially? Yes. And just, probably just to defend myself a little bit, we do not conduct revenue projections, we just look at the debt side. And it was, I guess, the city and the 4A Corporation were informed that the revenue collections at the time were very, right at the cusp right there, and that anything could happen back and forth. And so, but you know, we can't force our clients to issue bonds or not issue bonds. And so, the decision was just made at the time that, you know, let's do this, and so that's where it all stood.
What is the total amount of refinance then that you would be considering in 2015? What total dollar amount?
It would be anywhere from, depending on the time of year we did it, it would be anywhere from, I would say, I think 5.9 to $6.1 million in that range is what we would have to basically borrow to have to finally fix those payments out
Right.
and you do a long term, so.
and then you still proportion it out in the percentages that 4A is responsible for this, 4B is responsible for this, and the city?
No, so that's behind us, the 4A, I'm sorry, the 4B and the city with its participation in the Series 2008 issuance, that's just done and that's their own deal. The 4A will no longer be a participant in that 2008 issue. They've been stripped out, they have their own debt obligation, and whatever they decide next year to fix it at, that'll just be there. There won't be any participation by the 4B in the city at that point. It's going to be standalone, basically.
Mr. Guerrero, we say that it's their debt, it's really the city's debt at the end of the day.
Yes, it is, that's right, that's right. Legally, it's the city's debt.
But with the downgrade to triple B, how big an impact that gonna be on floating it? Is obtaining mortgage insurance something, since our rating has dropped so significantly? Those are all things you'll look at the time.
Yes, sir, yes, sir. It obviously makes things a lot more challenging to do when we do this restructuring. And then, y'all are ahead of me by a page. That's a great question. It's a good segue. Going over to, okay, the alternatives, you know, we didn't have to restructure, that was what we claimed. We talked about page 13. Before I go to page 14, page 13, we covered the two columns, A and B. B is what we have right now. C, that's just an illustration. Let's say at the time we could only afford $500,000 payment, what have you. You know, this is what it would be restructured to. So that $1.3 million payment isn't going to be there. The intent is to spread that out and not have to be responsible for that $1.3 million that 1 year, which we knew was not the plan and was not going to occur there. And so that's just an illustration. Column C is just an illustration. It's just an example of what it can be. It's not a decision that the 4A or the city has made. So again, it's just a projected figure of what it figures. We go to page 14. This is a credit ratings, and this is just to review. These are what we call investment grades, and we cite Standard & Poor's here because that's the rating agency right now that is a rating on the city. And then just based on the different category, this is essentially what it means as a bond investor. If I buy a AAA bond, that's the highest rating assigned. I'm going to probably give you the best interest rate possible because the likelihood of me getting repaid is extremely high. But if you start going lower in credit rating, you're going to start going higher in interest rates. You're going to start limiting yourself as to who's actually willing to lend me money. So here we have the AA category, which is very strong security, only slightly below best rating. Then we have the single A credit rating, which is an average security but more subject to adverse financial and economic developments. The A category is what we initially fell in when Standard & Poor's looked at us as a credit as a city back in 2010 when the restructuring occurred. Unfortunately, since that time, there has been a downgrade to the BBB category there. And BBB is still investment grade, but obviously it's not a AAA. So BBB, what it means is adequate capacity to secure debt. Adverse developments may affect ability to meet debt service obligations or requirements. Between those, you have a plus and a minus to designate each category. So there's different notches, as we call it. So that's what the investment grade ratings mean. What we don't want is ever to fall below BBB, because at that point, you all heard the term junk bonds. That's where it comes from, where it's below the investment grade line, you're below the BBB. That's when you start seeing junk bonds. Those are more common with corporations, not governmental entities. Governmental entities are safer than corporate bonds. So we go to the next page here, ladies and gentlemen, page 15. The city's credit rating history. Again, in 2010, when we conducted that refinancing, because of the structure we were using, we had to do and the flexibility that we're after, we had to do a public sale, meaning that we had to get a rating assigned from Standard & Poor's. At that time, we did buy, or the city bought bond insurance to market the bonds and not use that single A credit rating. And so at the time, Standard & Poor's looked at us as a credit, looked at the financials and everything and said, okay, in our judgment, the city of Floresville, as a debt issuer, their credit rating is an A-. And so that's what we received back in 2010. Unfortunately, the financial condition of the city did not go up or stay the same since that time. It actually went down. And so in 2013, last year, June 26, a year ago, what Standard & Poor's does, they not only look at you at the time you borrow money, but they also want to keep up and make sure that their rating reflects the condition of the city that it's in at that time. So every 1 to 2 years, Standard & Poor's will do what we call a surveillance call or a surveillance information request, meaning that they'll send you a request of these questions, and they want you to update their information to see where you stand, to see if you're still an A-. Well, after looking at us early last summer in 2013, and looking at the recent financial history since 2010 when that restructuring occurred and we received the A-, Standard & Poor's decided to downgrade the city to a BBB category, or BBB rating. And so right now, as we stand, Standard & Poor's has us at the BBB rating. I just want to say here, because it's not in it, but I was thinking about it when I was driving in from San Antonio, is because we'll talk about this on the next few pages, but about that time, if not before the summer of 2013, the administration at the time and the council at the time decided and approved and essentially adopted, I like the term turnaround plan better, because this sounds better than insolvency plan, because the city was never actually insolvent. But it was a turnaround plan, and actually we provided that to the administration back then for another issuer that we helped get out of the hole basically about 10 years ago. So that was a turnaround plan that we helped develop for another city. The good news is that right before Standard & Poor's looked at us again under the surveillance call in 2013, that plan was already adopted, put in place, and already starting to be worked on. My opinion is that if that plan had not been in place, adopted, and started being worked on by the city, it more than likely would have been less than triple B, because that's what we're illustrating to this, to the Standard & Poor's folks, is that, yeah, you know, the financials haven't been good, but we have a plan to get out of this, and this is our plan. We actually provided that detailed plan that the city adopted to Standard & Poor's when they were grading us again. So I just want to say that because I think that turnaround plan is vital. It was vital then last year because it would have been lower our credit rating if had we not had that plan in place. But it's vital now as we're trying to, you know, build and improve our financial situation. So I say that because we need to continue on that plan. You know, I know it's tough, it's difficult, it might require revenue increases, might require expenditure decreases, but, you know, it's tough, but it does have consequences on what we do with that plan. If we don't enact it and continue moving forward with it, then it's going to be more difficult to restructure these bonds next year. The reason why we wanted to wait till 2015 and not conduct that this year is because we wanted a few more months of this financial improvement to occur so that when we talk to Standard & Poor's again, or we talk to the bond investors, we have a better story to tell, and there's a better image of the city as a credit and as a borrower. So again, and I can't stress that enough, that turnaround plan is pretty vital, that we continue moving down that path. And
Mr. Guerrero,
yes,
saying
ma'am.
that, does that mean now that we're above water, that our rating will move up higher?
I can't say for sure, because I'm not an analyst, I can't say for sure it will, but there's a stronger chance that you will now that you're above water. And we continue that path until we restructure these bonds next year. You know, there could have been opportunity to do this restructuring actually right now because these bonds are callable next month, but we advise that let's wait. We're just above water, but we had just gotten right above water. So let's just give it a little bit more time to improve our financial condition so that when we do have to do this final restructuring, we hope it's a final restructuring, that we don't have to do it again, that we're in the best financial condition and the best image that we can to bond investors and help us get the better interest rate that we can for citizens of Florida. Going on, ladies and gentlemen, I'm not taking a lot of your time here. We just want to share with you the rationale of Standard & Poor's. Again, this is an independent third party that rates you based on your financial condition. One thing to keep in mind about these rating agencies, just real quick, is that they're going to measure you on two things. The first one is what can the borrower or the bond issuer control? You could control the way you budget, you could control the tax rates you set, you could control the expenditures that you incur or how you hold the line on the expenditures. That stuff you can control. So they rate you on that segment. The other segment that you're rated on but you can't control is, you know, economic conditions in the city. You can't control how many people move in. You can't control the property values in the city. You know, you can't control the rate that people are paying their taxes. You know, those are things you can't control, but you're still rated on. You're still rated on that. So the rating is not just on what you control, it's other stuff that you can't control. You know, what helps us is our proximity to San Antonio and larger metropolitan areas like that. But here, what I wanted to share with you is when Standard & Poor's did downgrade us, they shared a rating report, basically, is what they do. And we get that rating report, and then what we do as a financing team is that we have to alert the existing bondholders that there's a material event, we got downgraded. And so that was taken care of. But in that report, this is a summary of that report. These are the reasons why Standard & Poor's decided to take its downgrade action that it did. The first one, probably first and foremost, is again what we talked about earlier. You know, what they cited, again, this is Standard & Poor's talking, lack of willingness to align recurring revenues with spending. What does that mean? We're not increasing our revenues enough to match the expenditures that we have, not only in operating but in debt service expenditures. So that's first and foremost why they decided to downgrade the city. The second one, just lower than budget revenues and higher than budget expenditures, is pretty much tied to number one. The third one is just kind of just saying that, you know, most Texas cities are like this. The adequate wealth and income levels, we're about average there. Based on not only do they rate you with other Texas cities, but they also rate you with other cities in the nation. Is the way they come up with these ratings. The second to last one, moderately high overall net debt burden as a percent of market value. When they talk about overall debt, they're not only looking at the city's debt, But as a citizen of Floresville, I not only pay city taxes and city debt, I also live in Floresville ISD, and they have bonds outstanding. I also live in Wilson County, and they have bonds outstanding. So they look at everybody that has bonds outstanding and measuring you. And again, stuff that you can't control there. And then the last one is just the elevated debt service carrying charges. Just the fact that, you know, it ties to the first one where we have, you know, expenditures not matching, revenues not matching the expenditures that we have for our debt obligations. The last page here, ladies and gentlemen, is just, you know, moving forward. What I wanted to share with you is just give you that historical background as to what happened, why the decisions were made, what was the backdrop there. But, you know, that was that, and now we're here. What are we going to do moving forward? We know that we have to restructure that community center debt one final time. You could do that spring, as early as spring 2015. You know, I just urge you to continue that turnaround plan that the council approved and adopted, and I understand there's been some measurable improvement on that plan and progress. You know, we're trying to get you in the best shape possible so that when you do that restructuring, we get you the best interest rate possible. And the way we do that is by you all having a good story to tell and a good picture to show these bond investors that you are financially healthy, you were in a bad spot, now you're taking steps to improve it, and right now we are improving. And so that's basically where we go from here. Basically, you know, the decisions, the reasons why, and the people associated why, you know, that, you know, then what are we going to do now? Because now we have to restructure. Obviously, we can't keep that $1.3 million payment in place because that was never meant to be in place. You know, the good news is that sales tax have been vibrant, as shown on the other one. Last year, the Ford Corporation collected just over $700,000. Right now, your collections are exceeding that pace that you had from last year. So those are all good things. I understand there have been some improvements financially for the city internally, and so you know, I'm probably repeating myself. I just can't say that enough. Those are the key things that we have to continue doing, so that when we do lock up this 4A community center debt one last time, that we do it at the best possible rate, because that's going to be one of the final times we can pull the trigger on that. Yes.
Victor Q. Using status right now today, what do you think the rate differential would be between a B and an A minus, assuming we make a move to A minus?
Mm-hmm.
Because the thing we also have facing it is market risk. The stock market is down 300 today, and so if interest rates turn around and start back up, we may lose what we gained on the rate. So, but I don't know what those numbers would be.
Yeah, and I don't mean to be vague, but it does, because I know you're a bond buyer and everything, it does depend on who's issuing the bonds, it depends on when you're buying the bonds. But on standard, and I think this is probably just a rule of thumb, maybe for each rating grade, I would conservatively say that if you're like an A minus versus a triple B plus, I would think as an investor, I'd probably put a spread on that of about maybe 10 to 15 basis points, I would think, but that's on the high end. You know, that might not sound a lot, that's 0.1% or 0.15%, but if you look at a 20-year repayment schedule, that's obviously going to add up. But I would say that's probably a rule of thumb. Of course, it depends on who the credit is and when you're buying it.
I think and I concur, that what is the risk that this market will turn around and a 20-year bond next year would actually have increased more than 10, 15 basis points. So.
No, that's certainly a risk. Right now, we're in a historically low interest rate environment, and we have nowhere else to go.
It's a high risk that it's going to go up more than 10 to 15 basis points next year.
Yeah.
So you still think, based on the risk of the market moving, you still think they should wait?
You know, the main reason, or the main reason why about waiting is not so much the market risk, but essentially the city is in a position where it may have to wait because we're still not financially strong to, my concern is not only rate, but my concern is who's going to buy these bonds.
Okay, that's the rest of the story. I knew that this market by itself, there's a lot more risk by waiting
Oh, yeah.
than there is. But the other thing, you don't think they'd sell right now, possibly.
I think we could find a buyer. I think the buyers will be limited. And I think if things improve financially, you'll attract more buyers. And so, what I look for is not just one buyer, I want multiple buyers so that there could be somewhat of a bidding war and get you the best possible rate. I think right now there's more of a credit risk than a interest rate risk. There's certainly interest rate risk. You're absolutely right. We're a historically low interest rate environment. There's nowhere else to go but
That's
up.
right.
But right now is, can we even enter the market and get an attractive rate for the city based on the way the financials look right now? So that's my reason. Of course, okay, I don't make the decisions. It's up to the city and 4A what they want to do. That's just my rationale. I think there's more credit risk than interest rate risk at this point. And our hope is that when we pull the trigger, it could be even as early as 2015, just to show some improvements. The audit hopefully will be done by then for the September 30th, 2014 year. Because as a bond investor, I want the most accurate information, and there's no more accurate than the actual audit that's in place right now. Right now, we can't show an audit because we're not done with the 14-year first. So that's kind of our rationale, Mr. Eubanks. It's certainly there's an interest rate risk, but right now, I think what outweighs that is the credit risk and actually finding an attractive rate for the city. But no, you're absolutely right that there's that risk.
So, how does it affect the city if Phelps gets their bond as
What that does to
or
the
if we
city,
approve their bond?
yes, the Phelps and the city are two separate government entities. Even though the way their bylaws work, they have to get consent from the city to issue debt. But as a bond investor, if I'm buying Phelps bonds or I'm buying the city of Floresville bonds, to me they're totally separate because they're really separate entities. Although again, the bylaws, as a city council, you have to prove their debt. Where it does impact you, and why annually Phelps or the city are asking each other, okay, what are your debt plans each year? Because whenever Phelps does bond issuances, my understanding, just looking at the history of it, is that they usually issue $10 million or less in one calendar year. And they do that on purpose, because Mr. Eubanks knows if you're a governmental entity, you issue $10 million or less in one calendar year, you get to have a special tax designation on your tax exempt bonds, what we call bank qualified or BQ bonds. What does that mean? That just means more buyers. Banks now are able to get that tax-free income and write off those carrying costs. But what that means to an issuer, why they want to designate their bonds as bank qualified, because they're going to get lower interest rates on those bonds, and so they get more attractive rates. So that's why you typically Phelps, they might limit it to $10 million mark or less. And they're doing that on purpose to get better rates on their debt. The way the rule is that to designate your bonds as a bank qualified bond, you can only issue $10 million or less in one calendar year, not fiscal year. So that's why the way just the bylaws are working, even though, as a bond investor, Phelps and the city of Floresville are two completely separate entities and two different investments, two different revenue sources. The way the bylaws, my understanding from Phelps, I don't represent Phelps, but the way they work is that essentially they have to get the city's request for not only issuing debt, but even increasing rates. But they also have to share that bank qualified status each year. So that if the city is issuing $10 million one calendar year, then Phelps is completely locked out from issuing bonds that particular calendar year. So that's why they come to you really to get your permission, and they call, whenever they have debt plans, they call the city to say, what have you issued or what do you plan on issuing this calendar year? So if Phelps is planning on a debt issuance, then we have to keep that in mind as well. The only thing it does to the city, I'm sorry it's a long answer, the only thing it does to the city is it locks you out for that calendar year. If they issue up to $10 million, which is the limit for bank qualified status, it locks you out for that calendar year. So the earliest you could issue bonds, so you can have that bank qualified status, is January 1st of 2015 if they're planning a bond issuance this year. So that's just that's the way the Phelps financing would impact the city.
For the record, they are, and it's 9.5.
No, sir.
It's 9.5.
Okay.
Yeah, that's what they're asking for.
Yeah, so what that means is that basically if the city had borrowing needs, then all we could do, if we're going to let them do 9.5, all that leaves us on the table for the city is $500,000
For this calendar year.
For this calendar, yes, sir. Yes, sir. And so just up to December 31st, their financing is done by that point and closed and done, then it just locks you out to December 31st. And you can pull the trigger on this refinancing as early as January 1st, 2015, if you want to go ahead and allow them to issue their debt for 2014 calendar year. And then once you do this restructuring next year, if that's the plan, and you target the 2015 calendar year, you're going to use, $5, $6 million, whatever it ends up being of that bank qualified status. What that means, that leaves $4 million on the table, not only for you, but if Phelps needed to address something, or if they need to do a refinance, and that's all that's left on the table there. So that's why I think there's, over the years, just been continuing discussion between the city and Phelps about, what are your debt plans? Does that answer?
Yes, yeah. I just wanted to know the repercussions,
Yes, sir.
for.
Yeah, essentially, it ties your hands to December 31st, but based off of when historically audits have been prepared, and I know this year was a little bit behind schedule, and we hope that improves going forward, but really to do the restructure, we're going to need that 2014 audit in hand and ready to go.
Victor, where does the TIF, Riverbend TIF play in this bank qualified status? Because I think they're gonna have to do, I'm sorry?
A refinance.
Yes.
That one, to be honest, I'm not too sure about the legal specifics about the TIFs, and if the way this particular TIF is structured, if they actually use your bank qualified, but I could call the bond attorney tomorrow and get that answer for
That's
you.
Jim Plummer.
But that's a question I'll have to ask him. I do not know the answer to that, sir. I don't know if they, when they do their bonds, if they, I don't even know, sometimes they might not even be tax exempt. If it's not tax exempt, then it's not an issue because you can't do bank qualified anyway. It's just for tax exempt bonds. So we have to first see what kind of bonds that TIF usually, I don't work with them, what kind of bonds they do tax status wise, and if they do tax exempt, do they have to use the city's capacity for, or allocation for bank
I
qualified?
think all their bonds are being bought by local, one of the gentlemen that's been in it, well, their family's been in the bond business for years.
Oh, yeah, I think Emmy Allison's in it.
Yes,
Yes, sir.
yes, and I think Allison owns most of theirs, and I'm assuming because Allison owns them, that they're bank qualified, although that may be incorrect.
Yeah, it just depends. I mean, some funds, they buy tax exempt, taxable. It just depends what their portfolio needs. But no, we could definitely call Jim Plummer tomorrow and see what the answer is.
Okay, there's two things I want to.
And that's, again, if that's the case, if they do, you have to use the cities, and it's up to the council to, do we let Phelps go? Do we let the TIF,
But that's not just
go?
a city decision. There's 4 taxing entities in that deal.
Yeah, for Phelps?
For TIF.
Yeah, but obviously the council still has a say, one no obviously kills everything, and so, but no, we could find that out tomorrow morning. I do.
How much is that now?
I'm thinking their shortfall is somewhere around 3 million, but I may be wrong. I think that's somewhere in the ballpark. I'm not.
And they're wanting this fiscal year.
I'm not positive. I know that it's coming up there, but on the positive side of TIF, you've got the Riverbend organization coming on fairly strong. Their first unit is coming up. They've got hard plans, at least right now, for 500 units. The cities have passed and approved their form of unit development. They've got a track record up in Gonzales and over in Florida. So that's gonna come on much stronger. It's gonna help us with the property base, if nothing else, certainly with sales tax. The only other thing that I wanna add to your maybe echo, maybe not too good to echo, but we've got Richardson that's moving out of the city as a major car dealer, and they're not moving far, but they're moving up the road outside the city limits. And that's really gonna forecast a lot of other movement up there where Didmar and Richardson, and there's some movement on the bypass. There's a pad cut in there in the last 3 weeks. And it seems to me that pretty much says that we need to be doing serious annexation if we're gonna keep that tax base in the city.
Mhm.
Because when Richardson moves, that's gonna become a city, I mean, a FISD bus barn facility, and it's gonna be exempt.
Mhm.
And so that comes off the tax roll, not onto the tax roll.
Big sale.
And then you got a sales tax issue also.
Yeah, I don't know if the laws did, I thought a while back, I thought car dealerships, I think they pay sales tax, but they don't pay local, they pay state sales tax, but I think they don't pay local
No,
sales tax.
I think that's right.
The tax is only on the parts.
Oh, on the parts, yeah,
Service.
yeah,
It's not
yeah,
on
I'm sorry, I was meaning the
parts of
vehicle
vehicles is only
purchase, yeah.
state tax.
Yes, vehicles go state, that's
Yeah,
right.
yeah. So.
But the
But still,
fact-
you have the parks.
You don't know.
No, but the fact is,
That's what he's speaking.
I guess
To
all.
tell that, they don't sell that many cars anyway, so.
You car dealers and bankers at the same level.
Trader, trader.
One thing, if I could, we could, you know, a couple of years ago, y'all appointed a new 4B board and things like that, and we inherited some issues to deal with and whatnot. We had some contract obligations that we were several years behind on, of which roads being in Rancho Grande. We have now obtained all the land back that we need. We're able to engage engineers, actually do the engineering for us to go out and actually get performance bid bonds so that they can go out and solicit bids on that. We cut back on spending pretty severely, as you know. We were criticized a lot. No fireworks, I've heard it all, we did not do anything, but part of it was out of necessity. I think that where we are now, that we're probably able to fund that road out of cash. So we're not gonna have to float a bond to do that or go seek any kind of borrowing. We still have the retention ponds, which are significant debt and all like that, but we needed to get the county off of, let me rephrase that. We need to make the county happy and put the roads in. Trying to be politically correct here. And so we've come a long way. The board has been, y'all been gracious to let it kind of work pretty independent, knowing where we're going like that. The board on FEDC has been great, so I think that we're turning this around and can look forward and backward a little bit both. So that's the 4B is gonna be in a lot better shape for y'all, so you won't have to worry about that, hopefully, so. Thank y'all for keeping
What
you,
y'all have done.
thank y'all for letting us do the work we needed to